the solution here. Okay, so um, March 4th, this is a review of what we did in the last problem. It's just issuing this stock, but now we have that issue with the par value. So on March 4th, we're trading cash for stock in the company, and we're going to have common stock, $1 par value. We're also going to have paid in capital in excess of par. So hopefully you remember this added little detail. So we're issuing the shares at $18 a share, and there's 22,000 of them. So that's how much cash we're bringing in. And of that, 22,000 shares times the par value, which is $1 a share. And then the remainder is going to be paid in capital in excess of par. Okay, so hopefully this was review. We did a whole problem on this before. But now we're going to talk about the treasury stock transactions. So the first one, we're going to basically buy back 1,400 shares. So May 22nd, this time we're going to be spending cash. And you can figure that out by just doing $11 per share times 1,400 shares. And we're going to have that stored in this treasury stock common. Okay, so now we have this $15,400 debit balance. Okay, so now we're gonna sell 500 of these shares for $24. So did we do a good job? Were we smart? Yes, because we bought at 11 and now we're selling it back to the market at 24. So we're gonna have a profit here. We're gonna have to use that other account that we had, which was an adjunct account, right? It's also gonna be credit. Okay, so let's just go through the steps here. So we're receiving cash. This is on September 22nd. We're gonna get cash, $24 a share times 500 shares. We're giving up treasury stock. And again, this account is always going to be accounted for at the cost basis, like the cost per share. So we bought these at 11 and we are selling them. There's 500 shares that we're selling. Okay, and then the remainder is going to go into this paid in capital from treasury stock transactions. So this is kind of like the profit that we earned from this trade. Okay, so this is going to be 6,500. This is going to be, okay, so remember, we kind of need to track the number of shares too. So this was originally 1,400. We just sold 500. So we still have 900 shares left at $11 each. Okay, so okay, so right now, I guess we can do a little balance as of now. This is 900 shares. Okay, so now there is another transaction. We sold the rest of them. Basically, we're gonna sell the rest of these 900. And this time we're taking a loss. We're selling them at $9. We bought them for 11. So what we'll do is, again, we're gonna be receiving cash, 900 shares times $9. The treasury stock is gonna be transacted at our cost basis. Actually, let's do this. And basically, this is going to go to 0, right? We already kind of know the amount. This is going to have to be 9,900 because we no longer have any shares. We should have a 0 balance, 0 shares. And again, we can confirm that by doing 900 shares times our cost basis of $11 per share. And then in order to make this journal entry balance, we're going to need an additional amount of debit. Okay. And remember, we're basically going to take it if there's a balance in this paid in capital from treasury stock transactions, we're going to take it out of this piggy bank. This is gain. Now we're taking a loss, so we're going to kind of draw it down from here. So this is going to be coming from this account. Let's just do it like this. Okay. So now at the end of this, the balance is 4,700. Okay. And this account balance is 0. All right. Is everyone good with that? Okay. So now let's do the hypothetical where we switch the order of these two. Okay. So we're going to first, so just pretend like we're kind of like, this is all correct, but let's just pretend that we just are starting from here. Okay. So I'm going to get rid of some of this stuff. Okay. And let's see how it's going to change what we do. Okay. So if we first had this transaction happen, sold 900 shares for $9. Okay. It's going to happen on September 22nd, where this is going to be unchanged. We're still going to get this much cash. Remember, it is just 900 shares times $9. This is going to be the same because we still bought them for $11 each. This amount is going to be the same, but since we don't have any balance here, what are we going to do? What should we debit? We have zero balance here. We haven't done that transaction where there was a gain. So we can't just debit this 1800. This has to be a credit balance or zero. So where should we debit this 1800? Yeah, retained earnings. Okay. We're going to take this out of retained earnings. Okay, so let's just add another T account here. Okay, so we would have had some starting balance. Let's say we had $150,000 of retained earnings. Now this loss, we're going to kind of reduce this 1800 because we took a loss. We spent $11 per share and we're selling it back at 9. So it makes sense that our equity balance is going to go down because our net worth went down. We lost money on this whole transaction. Does that make sense? Yeah. Okay. So now we're going to do this other transaction where we sold. Okay. So then let's just finish this off too. So we did 9,000 or what was it? 9,900. And this was for 900 shares. So right now our balance is this minus this, and we have 500 shares left. Okay, so now we're going to sell those other 500 shares. Again, the cash is going to be the same as this, 12,000, which is equal to 500 shares times $24 each. The treasury stock is going to be the same as this, because remember, this was 500 shares times $11, our cost basis. Okay, so now this we would put in paid in capital from treasury stock transaction. Okay. So in that case, we would have this is going to go to 0. So we end up with 0 shares, as we should. And this is 6,500. Okay. So um, now the net equity is the same. The order didn't matter. It's just that in the previous example, if you remember, we had, let's do this. This is version 2. Version 1 of this was this, and we had 1,800. So we had a balance of this minus this. Okay. And this is version 2. Oops. Version 2. Version 1 of this was this not existing. Okay. So if we look at the total balance of equity from version 1, we have this balance plus this, right? These are both the version 1s. And if I take the version 2s, I have a larger balance here, 6,500, but I have a smaller balance here. Okay, so if I take version 2 retained earnings plus version 2 of this paid in capital, you can see that the equity balances are the same. The total equity is the same. The order just kind of changed what accounts they're in within equity. Okay, does that make sense? Version 1, again, was the traditional order that the problem was stated in. Version 2 is when I just reversed the order. Okay, but the end point, the net change to equity is the same. It's just, again, been split because the order did matter as to how we were going to account for it. Okay, everyone good with that? Make sense? Okay.
When you do balance sheet, we're gonna report whatever treasury stock we have. If we have balance we paid in capital from treasury stock transaction, should it be also in balance sheet or count the
This,
way of
yeah, this paid in capital from treasury stock transaction account, it's like, it will. They're usually smaller amounts because companies don't traditionally buy stock back and then resell it, and like that's not a very common thing. Let's look at a real example. We can think about where it's going to be because you won't see this account paid in capital from treasury stock transactions. It's probably not going to be listed in the financial statements. It will be subsumed under something else, and we can think about where that's going to be. Yeah.
thank you. And then how you said the approach of lending the like the sorry, like the lines of it, like how it's like going to like the second part of it. Is that whole like is that you always have the ability to do that, or is that just with some specific problems?
Yeah. So which part of this are you talking about?
So how in the beginning you said for the section where it said May 13th and June 3rd, like sometimes you'll lift them.
May
Is that
13th.
always able to do that, or is that just like or sorry, yeah, March 4th, May 22nd? Are you always able to do that, or is it
No, no, I just switched these two.
those two?
Yeah, yeah, yeah. So I switched the order of these because I sold a total of like I basically bought 1,400 shares and I sold 1,400 shares, right? All I did between these version 1 and version 2 here. So version 1 is when as this one said, I first sold these 500 at a profit and then I sold the 900. Then I would have got my T accounts would have been version 1. It would have ended up like this, and my retained earnings would have been like this. Instead, if I reversed the order of those transactions, meaning I sold those 500 shares at a loss, and then, or what was it? Not sorry. If I first sold these 900 shares at a loss and then sold these at a gain, it would have resulted in this version 2. Okay.
It's basically like just getting like two separate versions.
Yeah, exactly.
Taking
I was just
sure it balances out.
exactly. I was just showing. I was trying to demonstrate that the order actually does matter because if you took that loss first, you wouldn't have had a balance in this paid in capital to like in the first version. This is the first version, right? Since we got this gain, we have this balance, right? We could then take it out when we take had the loss. If you reverse the order, this loss, you don't have that paid in capital account because you're taking the loss first, right? So in that case, we had to take the loss to retained earnings. And then in the second transaction, we have the gain. We would have the balance there. Well, you don't like in the real world, maybe you're going to have the loss transaction first, right? You're not always going to have this paid in capital from treasury stock transaction happen first, so you have a balance in it. It could have went either way, but it would have changed how you counted for it depending on how it went down. Okay. 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 All right. So let's move on. Unless there's any other questions from this. Any other last questions? No? Okay. Okay. So now we're going to talk about dividends. Um, so the added information on dividends that we didn't really talk about um, is that there's a specific timeline for how dividends are paid. Okay. So there are three relevant dates for when dividends are paid. Okay. So again, this is for cash dividends. Okay. So there are three important dates. The declaration date, this is when the board of directors does a press release or somehow conveys to the public that a dividend is going to get paid. It is this day where we are basically going to account for the dividend. Okay, so there's going to be a journal entry on this declaration date. You're going to debit dividend and you're going to credit dividend payable. You're not going to credit cash yet because the dividend is not getting paid on the same day that it's declared. Okay, but the board of directors has made it official that the dividend is going to happen. So that's why we're going to debit dividend. Okay. This ex dividend date, um, the date of record and the ex dividend date are closely related. Um, the ex dividend date is basically the day upon which you need to own the shares to get the dividend. Okay. Um, there's a cutoff date because, as you know, shares are constantly trading between parties. So this is the date whereby if you are the owner of record, you will get the dividend. Even if you sold the shares the next day, you will still get the dividend on that date, as long as you were the owner of record of that date. Okay, so there's no journal entry here. This is a pure record keeping thing where the company's just figuring out who they have to pay. Okay, um, the amount is unchanged. You still haven't transacted cash. It's just now you have a list of all the people and the proportions, the number of shares that you're going to pay the dividend. Okay. And then there's a payment date. This is when the cash actually is going to go to the people in the proportion that you determined on the ex dividend date. Okay. So this is when you will debit dividends payable and you'll credit cash. Okay. So just to give you a look on how this actually looks, this is kind of the dividend history of this company, WP Carey. It's like a real estate company. You can see that they pay a quarterly dividend, and so they have the ex-dividend date and the date of record are either the same day or like one day apart. Okay, because there's like sometimes the ex-dividend date is on a holiday. Um, but basically you can think of this as when they're checking for who the owners are. Okay, this is the date, and then they have the date that it was actually paid and the amount. Okay, so again, the declaration date is not on here, but if we wanted to see that, if we went to news, it's probably going to be here. Okay, so see, Yeah. Here's one example where there. Okay, so yeah, so there will be some press release that announces the dividend. Okay, or some way that they're making it known that the dividend is going to get paid. Okay. Um, so any questions? Yeah.
Is always dividends temporary account used, or it goes directly through retained earnings sometimes?
Um, I didn't follow. So what is the question?
You are debiting cash dividends. Could we just directly take it from retained earnings?
Well, if you remember when you close the period, the dividend eventually does get rolled into retained earnings, right?
Never directly.
Yeah, I mean, maybe there's some companies that will directly do it because they just because as we talked about, the closing process is like kind of a relic of the past, before there was like computerized systems. So it could be that they've set up the accounting system to not have a dividend, yeah, a dividend account. It's possible,
Okay.
yeah. And you would be correct to do that too,
It's either way,
yeah.
retained or
I would say a business may want to track their dividends, so they would have a separate account for it. But if you did just directly debit retained earnings, your equity balance would be correct. You would just maybe lose some of that information in a separate account. Yeah. Okay. Um, okay. So just the journal entries, just to reemphasize, this is on the declaration date. Um, they declared a dividend, 5 cents per share. There's 225 shares outstanding. You're also going to say when the ex-dividend date is and when the payment date is. But on the declaration date, you're going to basically account for the dividend, have the dividend payable. And the way we got this is 5 cents times the number of shares outstanding. Okay, that's where that number is coming from. On the ex-dividend date, no journal entry, but you will then have a list of all the shareholders and their respective share count as of this ex-dividend date, and that's who you're going to pay. And then on the payment date, of course, the cash is going out, and it's going to go out. It's going to be to all your list of people. So this is in the form of one journal entry amount, but it's really split between however many shareholders you have. Okay. And then, of course, you close dividends to retained earnings. As we learned in chapter 4, at the end of your period, this is a temporary account. It's going to go to zero, and retained earnings is going to get reduced by the amount of dividend you paid. Okay, so hopefully you all remember that retained earnings. Gosh, oh man. Retained earnings equals revenues minus expenses minus dividends. Okay, so this is getting reduced. Retained earnings is a credit normal. So this is a dividend, which is reducing retained earnings. So hopefully it should be in review. You should all remember this. Okay. Okay. So companies can also choose, instead of paying cash to their shareholders, they can issue new shares of stock. Okay. This is similar to stock-based compensation, where your employees are working for your company, and instead of paying them cash compensation, you give them shares in your company. Now, this is beneficial. Again, we talked about this, but just to review, it saves the scarce cash that the business has, because instead of paying the cash out to the employees, they're able to give them stock. It incentivizes the employees to have a long-term kind of stakehold in the business by having them hold shares. And usually the shares are not just given out right away. You have to work at the company for usually 4 years to vest that equity. Um, so in the same way, a business, if it wants to conserve cash, sorry, I was about to sneeze, but still wants to give the shareholders something of value, they will issue new shares. Okay. Um, Now, of course, it's just like printing money. If the government prints money to everyone, yes, you get dollars, but there is a dilution effect from that, right? Just like we have inflation, companies, their version of inflation is called dilution. So by doing this stock dividend, you are diluting the ownership of your business. Now, it's not quite the shareholders are not necessarily going to care because they're receiving, if they own 10% of the company's shares already, they will get 10% of the new shares that are created. So as a total percentage, they're not really changing their ownership. So it's not quite the same thing because everyone is getting a proportionate number of new shares as proportionate to their current ownership. So though there's more shares outstanding, each shareholder's stake is unchanged. Okay. Um, it is pure financial engineering. There's no effect on the assets or liabilities. And as we're going to see how it's accounted for, you're just shifting around balances between the equity accounts. Okay. You're going to move money from retained earnings, dividends. We're just going to be moving stuff around from retained earnings to paid in capital, as we're going to see. Okay. So between the two, there's no net effect. Your the balance, your assets equals liabilities plus equity, it's going to remain totally unchanged. It's just within equity, we're moving balances around. Okay. So this is what we mean by financial engineering. You're not actually creating any value. You're just doing things from accounting or, you're just moving balances around. Okay. Um, but, there are reasons that it is useful. Okay, so within stock dividends, there's two kind of classes, and within these two, you're going to account for it differently. A small stock dividend is when you're issuing less than 25% of the outstanding shares. So, for example, if you had 100,000 shares outstanding and you have a stock dividend of 24,999, it's a small stock dividend, okay, because this is less than 25% of the shares outstanding. Is everyone clear on that calculation? Yeah. A large stock dividend is just anything above 25%. Okay. Um, as we're going to see when we account for a small stock dividend, we're going to use kind of like the market value of the shares to calculate the value of the stock dividend. The assumption is that there's a small stock dividend is not going to cause a market changing kind of valuation change to the stock price. Okay. A large stock dividend is going to assume that the dilutive effect is very large. And so the price per share is going to go down. Okay. Like, for example, I think we saw with Amazon, there's like 10 billion shares outstanding. Okay. If we created like 500,000 new shares, it's not really going to change the per stock value in the stock market materially. But if we issued 5 billion more shares, yeah, it will. Okay. So this is kind of the logic between small versus large stock dividend. Okay, so this is just for to see an example. Transaction one, this is small stock dividend. Company is going to distribute 5% of a common stock dividend on 2 million shares issued and outstanding. Okay, so how many new shares are going to be created by this? What is 5% times 2 million? What is that? 10% is 200,000. 5% is 100,000. So we're going to issue 100,000 new shares. Okay, does everyone understand the math? Yeah? Okay, and it's $1 par value stock. We're going to need this $50 per share. If you were to go to the stock market and look at how much these shares are trading for, we would see that they're worth $50 a share. So because this is a small stock dividend, we're going to assume that this $50 per share is not going to change by that much. So we can directly ascribe a value to this 100,000 shares. It's just going to be 100,000 shares times $50 per share. And that's going to give us this value here, $5 million. So we're basically issuing $5 million worth of new shares based on the current value of the stock. Okay, so we have this dividend, 500,000, and it's like we're issuing new shares. So that's why this part of the journal entry was exactly the same as if we had issued these new shares for cash, right? And we would have done cash, and then we would have had this if we were issuing the new shares to the public and selling them. In this case, we're paying them out. We're just giving them to our shareholders. So we're going to have this dividend. Okay. But this part of the journal entry, the credits are the same. Okay. So now when we distribute, uh, we're going to basically, um, okay, so it's a little different. Okay. So you can see here that this is like we haven't yet distributed the shares. We've just declared them. So this is common stock dividend distributable, 100K. Paid in capital in excess of par, we will recognize this on the declaration date. And then when we actually distribute the shares, we will just mess with this par value. We'll create the new shares here and then get rid of this. It's like a liability. We'll get rid of the liability. Okay, so now the shares are actually created. This one we actually distribute the shares. Okay, so just to see what the T accounts look like. So we started off with these 2 million shares. We issued 100,000 more. So this is the par value of all the shares that have been issued and outstanding. For paid in capital, we started off with this. We just had this 4.9 million come from this right here is going to be here. And then this, of course, goes to zero. That was like a temporary account that we just needed when we first declared the dividend. And then this is going to also go to zero, this stock dividend, when we close it. So this is a closing entry. You can see our retained earnings gets reduced as if we had paid a cash dividend. Okay, but we didn't pay any cash, right? We basically just moved some retained earnings is offset by this and this. Okay, so this this debit is related to this credit and this credit. Okay, so we basically reduced retained earnings by 5 million. We increased these two by 5 million. Okay, so we just moved money from retained earnings to paid in capital. Okay, you could think about it like this, where you paid your employees $5 million of cash, and then you immediately took the money back and gave them shares of your company. Okay, so you could think of it like paying your shareholders a dividend, $5 million cash. They have that money in their pocket for a split second, and you're like, hey, actually, give us the money back and we'll give you shares. Okay, so you've conserved your cash and you just issued new shares worth $5 million. Okay, but you're just doing it kind of in one step instead of having that cash go back and forth as a dividend. Okay, so you've just, again, the net result of this is that you've retained earnings has gone down, paid in capital, the number of shares that you've issued has gone up, and they totally offset each other. Okay, this $5 million is actually kind of arbitrary too. Okay, as we're going to see with the large stock dividend, because again, the total balance of equity has not changed at all. Okay. Okay. So now, if we look at the, uh, the balance sheet here, just this equity section, you can see that the retained, so this is before the small stock dividend and this is after. Retained earnings was 9 million. It's now 4. Paid in capital was 21,055. It's now 26,055. This is totally unchanged. Okay? Does everyone understand? Like we're just again, this is what I'm saying. Financial engineering. We had just moved around balances within this equity section. There is no net change to anything. Okay? Okay. So now when we do a large stock dividend, so now we're going to issue 50%. The market value is $50 a share. What is a journal entry? Well, now what we're going to do is we're going to ignore the market price because the market price is going to change a lot now that there's so many more shares. Okay, so it's a kind of irrelevant price. We're just going to use the par value. Okay, so the way that we're going to account for this is $1 per share, 50% of our new share count. Okay, this is going to be a tricky part of this chapter. You have to keep an ongoing record of how many shares you have outstanding. Okay. So like treasury stock transactions, right? Maybe you bought some shares back. That's going to reduce the amount of shares outstanding. And then if you did a stock dividend, it has to be on that share count. And now we issued a small stock dividend and now we're doing a large stock dividend. So we have to make sure we have the most current number of shares outstanding because the 50% of new shares is going to be based on that most recent shares outstanding count. Okay, so it's pretty much the same. We don't have any paid in capital in excess of par. This is like the big thing because remember, in the small stock dividend, we calculated this value based on the market value of $50 a share. We're no longer going to do that. We're like, the market value is irrelevant because we're creating so many new shares. So the market is going to obviously react to that dilution. So we're just going to be like, forget that. We will just use the par value and do the journal entry like that. Okay, so this is when we declare it. When we distribute the shares, we just use the par value again. And then you would see again that this amount is going to also be unchanged. We would have just basically further reduced retained earnings by 1 million. And then we would have increased this by 1 million, whatever, 1,050,000. Okay, so this would have went down 1,050,000. This would have went up 1,050,000, and this would be unchanged. Okay, yeah,
In those cases, when company decides to have no par value, how they manage it? Or
yeah, good question. Yeah, I mean, as you can see, the number is actually irrelevant. Um,
can choose
yeah, they'll choose something. Yeah, there's some way they'll do it, but it actually doesn't matter because it's just moving balances around. So it will still not really change the overall total stockholder equity. Yeah. But this is why again, like a lot of companies will keep their balance sheet clean because there's a lot of information in retained earnings, right? That's like the lifetime earnings of the business. So if you're doing all these games, then that number becomes unreliable. So so yeah, this is why you want like, you want managers that care about presenting their financial statements in a transparent way, right? Not all businesses will do that. They'll play a lot of games. And then the financial statements become just like not as useful as they could be. So yeah, so that management does have a lot of say in, making their financial statements good and useful. Okay. Okay, so and then we have stock splits. Okay, this is has a similar effect to the share count as a stock dividend. It's just the mechanism of how it happens is different. While the stocks, so the stock split is going to affect the par value of the stock, while the dividend does not. So you can see that the stock dividend, we kept that $1 par value the same. And a stock split, you're also going to have a bunch of new shares, and each shareholder is going to get a proportionate kind of more shares. But the mechanism, you're not using the dividend account to do anything. You're just going to split the par value. Okay. And again, if there's no par value, what the technical way they do this, I'm not quite sure. Okay. We'd have to see. But you're basically not paying a dividend. You're just increasing the number of shares in a directly proportionate manner to who owns what. So if you owned 100 shares and there's a 2-for-1 split, you're going to have 200 shares now. Okay. You can see here that this balance does not change at all. It's just uh, this has changed, and therefore you go from this to this. You're just doubling the number of shares by changing the par value. Okay, but functionally they're the same. You've increased the number of shares outstanding proportionate to whoever owns your shares. So from the perspective of the shareholder, there's not really much difference in terms of the net economic reality of what's happened. Okay. Um, okay. So in summary, um, we have cash dividends and we have small stock dividends, large stock dividends, and stock split. You can see the stock split has no effect on anything. Okay. It's just a pure changing the par value and increasing the stock. There's no change in any of the account balances. Okay. Cash dividend, why is your total assets decreasing? What do you pay? Why is that? When you pay cash dividend, why is your total assets decreasing? Yeah, Mohammed, why? Yeah, because you're paying cash. You're taking assets off your balance sheet, your cash, and you're distributing it to your shareholders. So cash dividend is going to obviously decrease your total assets. Um, there's no effect on any of this stuff, but of course your retained earnings is going to decrease. Okay, as we know from the accounting equation, and your equity is going to decrease. Okay, so the cash dividend is real. You're taking real value and you're giving it out to your shareholders. Okay, uh, so that's going to have a real effect on your balance sheet because you're taking something real. The rest of this is all financial engineering. Okay, so you can see here that all of these have no effect on the total stockholder equity. You're just moving balances around. In this case, you're literally doing nothing. But for these two, you're just moving balances between retained earnings and paid in capital. Okay, you're just shifting it around, and there's no net difference in the total. Okay, so is everyone clear on that? Okay. Okay, so let's do a couple of problems. 13-51. Let's start with that. Again, I will say the hint I will give you is you need to be tracking how many shares outstanding there are after each transaction. Okay, because you're going to see here, you're going to pay a cash dividend, you're going to have a stock split, that's going to increase the number of shares. Then you have a stock dividend, so that's going to be based on the new after split stock count. You're going to purchase treasury stock, so that's going to reduce the share count. So just make sure you're tracking how many shares are outstanding at every given moment. Okay. Okay. So why don't you try doing this, and then we'll do it kind of in parts over the course of the class. Okay. So we declared a cash dividend on both the preferred and the common stock. Okay. So we're gonna have cash dividend. All right. Let's do it like this: dividend, cash. Because now we learned that there's not just one type of dividend. There's cash dividends and there's stock dividends. So we're just going to clarify that this dividend is a cash dividend. And there, we're going to have two dividends payable. Dividend payable for preferred, pref, dividend payable for common. So we have the accounts that we need. Now we just need to figure out the amounts. So the preferred return is going to be 6%. Par value is $95, and there's 1,000 shares outstanding. So we could just do 0.06 times $95 a share times 1,000 shares. Okay. And then the other one is 55 cents per share on 90,000 shares. So that's just 55 times 90,000. Okay. Is everyone clear on the calculations for those? Yeah. And then you just add them up to get the total dividend that you got to pay. Okay. And then the second transaction on February 15th is we pay the cash transaction. So again, this was January 16th. On February 16th, we're now going to distribute the cash. So these two are going to go to zero. We're going to credit cash, 55,200. And the common is this. And this one is this. Okay, so now these dividends payable are now zero. And we've paid our cash dividends to our uh, respective classes of equity. Okay. Any questions on this? Okay. Stock split, June 10th. Do I need to do anything for this? Any journal entry required? No, no journal entry. But what I want to do is make sure that I know that I have how many shares of outstanding now. How many shares of common stock are there? Well, there were 90,000. There's now, no, it's 2 for 1. So for every one share, there's now two. So it's 180,000 of $5 par value stock. Okay, because it was $10 par value. Now we have, so I'm just going to put a note here, 180 shares, 180,000 shares, $5 par value outstanding. Okay, so that's going to be relevant because now in the next journal entry, we're going to pay a stock dividend on 30% of the outstanding common stock. Okay, so I'm going to pause it now. You guys can continue working. Figure out if it's a large or small stock dividend, hint, and then depending on what the answer to that is, you'll do the journal entry. And then these last two are just review of our treasury stock transactions. Okay, so take a second, try to wrap this up. Okay, so there's a couple of like miscellaneous topics that the chapter has us go over. One item is continuing versus discontinued operations. So they're as businesses are, they're constantly changing. They have many different business lines, and sometimes the business will either sell part of its business, some segment, or it will just shut it down. And so if you're not told that, then you can get mislead, like you could be misled by the kind of the financial performance, because if one quarter you have this existing segment and then it's gone in the next quarter, there will be a big drop potentially in the profit or the revenue. So what a company will do is break out any of the like income attributable to discontinued operations. So you can see here that this is for 3M. So they present all of uh, They basically go through the whole thing, um, and they then show how much is from just discontinued operations. So they'll give the combined all the stuff, and then they're also going to add this back in. So actually, hold on. Let me restate that. So this is from continuing operations. So what they're going to do, actually, this is a good and transparent way of doing it. What they do is they take only the things that are still going to be in existence. They provide the income statement for all of that. They give you an operating income, and then they just add in whatever net income is associated with the discontinued operations, because that's still profit that they're earning in this period, but it's not going to continue going forward because they've kind of ended that segment. Okay, so you can explicitly see how much of the total 3M's net income is from this discontinued operation. So what you would do as an analyst is basically subtract that, right? You now know of this amount, how much of it is from this part of the business that's not going to exist going forward. So you can more easily make an adjustment in your analysis. Okay. And if they hadn't done that, then you would have had to guess. You would have had to kind of use some estimate of how much of this was from some discontinued thing, because they probably have announced at some point, hey, we're selling off this part of our business or we're shutting it down. But they're making it explicit in the financial statements of how much net income is coming from that segment of the business that's now no longer going to continue. Okay. So this is just kind of general information for you to know that companies will explicitly tell you how much of their profit is coming from something that's not going to continue going forward. Okay. Now, the rest of this you can use in your analysis because it's from the continuing operations. So all these numbers are from just the part of the business that will be moving forward. Okay. So it's set up in a way to make your analysis as a financial statement reader a little easier. They also do something nice where they have the total earnings per share, but they've broken it out between how much of it is from continuing operations versus how much of it is from the stuff that is in the current financial statements but won't be in the future ones. Okay, so again, this will help you be like, okay, well, this is really the earnings per share that I need to consider on a going forward basis. Okay. Um, Any questions on this? This is just kind of background information and understanding when you see an income statement and you see these terms, what they mean. Okay, so hopefully it should be a little more clear now, unless there's any questions. Anyone want to ask anything about this? Pretty clear? Yes? Okay. Okay, so this is the statement of shareholder equity. I think we've seen this kind of a couple times in the class, but just to revisit, now that you've spent a little more time with the equity section of the balance sheet, again, this is a separate financial statement than the balance sheet. Okay, the balance sheet only is going to really have these totals: this total equity, retained earnings, additional paid-in capital. These totals will be on the balance sheet, but now you can see how they've changed over time. So you can see this is the balance as of the last year, and then this is the current balance sheet. And so you can see the change in each of these account balances, and that's why this statement is useful. So we know this one, right? The statement of retained earnings we've seen, but of course, retained earnings is only one part of the total equity. So you can see here, just from the way we've learned it, we have starting balance plus net income, right? This is the net income being added minus dividends, which is here. They're also putting in treasury stock, okay? This negative number is a debit balance. That was as we saw with treasury stock transactions. So they're rolling treasury stock into retained earnings. It's included in that number. Okay, is everyone seeing this? So you have cash dividends, which is this 1.7 billion, and then they bought back stock 653 million. Okay, and these are both reductions in retained earnings. Okay. So, but you can see here they earned quite a bit. This is Costco. Okay. So their retained earnings still went up because they're still reinvesting in the business. You can think about it like that. These two, dividends and cash, treasury stock transactions, are ways the company returns profit back to shareholders. But you can see that they're not returning all of it. They're still earning much more than they're returning back to shareholders. That's why retained earnings went up. Uh, in this one, there's something interesting here. This stock-based compensation, okay? What this is basically this journal entry. Salary and wage expense, debit, and instead of crediting cash, they're giving their employees stock options or stock in the company. Okay, so you can think of this is like the earnings. This is the value of the labor that the employee has given. Instead of paying them with cash, the company has compensated them with stock. And so this is the value that the employee has paid into the company, right? They've contributed their labor worth 778 million, and in compensation for that, they're getting stock in the company. So that's why this is an increase in additional paid-in capital, because the employee is contributing their labor. Just like an investor is contributing cash, which has a value, the workers are contributing their labor and they're getting compensated in stock for that. Okay. Um, so that's, there, a lot of accumulated other comprehensive income. This is things from like, okay, you can see it's actually written here. Um, Foreign currency. So Costco has stores in Mexico, stores in the UK. When I was at my cousin's wedding in London, they had like Kirkland water there. So, all these, Costco's generating revenue in a bunch of different currencies. So you can see here that there is some foreign currency adjustment. So it must be that these other currencies appreciated against the dollar. So that's why this is a positive adjustment. So you can see, all these different elements are kind of factored into the equity. Okay. Um, and in the end, you'll see this total. This is what's going to be on the balance sheet. And it's going to be, again, you're just going to see really this, um, this, this. You'll see all these totals. You're not going to see the changes. You need this separate statement of equity to see what's changed. Okay. Of course, you'll see this. This is going to be on the income statement, but now you're seeing how it factors into the the change in equity over the period. Okay. All right. Any questions on this? No? Okay. This is, I'd say, maybe the most complicated transaction, like statement, and really maybe the most important. The income statement is also important. You can see that quite a bit of the change is from the net income. But what's going on with these, like this one, stock-based compensation, these two are related. Now, the details of how all this happens, I'm actually learning this too. This is a kind of complicated, because the company pays for the tax, uh, kind of if you as an employee get stock, there's a tax from that, like an income tax, you can say. So the company is fronting that money. So there's actually a lot of detail in stock-based compensation. This is a topic I'm learning about myself. I don't know everything. Okay. But it is now, companies pay their workers a lot, especially tech workers, in stock-based compensation. So knowing the true effects on the balance sheet from that, it's important. And, so I think if you're going to pursue accounting, you should have this kind of like always learning mindset because things change. If you look at a company's balance sheet from 50 years ago, stock-based compensation was like not a thing, but now it is in the last 20, 30 years. Okay. Um, okay, so uh, This is just Apple's. This is a different format of how they do it. Um, they again just take the total shareholder equity from the last period, and um, they're kind of okay. So they're taking beginning balance. They're showing how many shares were issued. So they're kind of doing it by first paid in capital, and then they're doing it by uh, retained earnings. But believe it or not, Apple has like accumulated deficit. They have negative retained earnings. Okay, so why? I don't know. We'd have to look at the history. They've, it did almost go bankrupt at some point, but it's been so profitable. So I'm not sure why that is. Yeah, okay, this is why. Though they're very profitable, they do a ton of stock buybacks. Okay, so you can see here that though they're generating 112 billion in profit, they're buying back 90 billion worth of stock. Okay, so they're returning most of their profit back to the shareholders. Um, so okay, and yeah, actually, yeah, and they are doing because you can compare these two and see that yes, actually, they're how much stock they're giving to their employees is less than what they're buying back, the value of it. Okay, so they are net giving money back to the shareholders, the actual financial investors. Okay. Um, so this is just another format. I just wanted to show you this is like a different, it's this same statement, but just presented a little differently. Okay. But it's basically doing this. It's going from beginning balance of equity to ending balance of equity, just like this is going from beginning balance of equity to ending balance, are actually here. Yeah.
So if they are buying back shares,
Hmm.
that it, what effect it's gonna have on outstanding shares? It's gonna
Decrease that.
increase the prices or the
Yeah,
bond.
yeah, that's one reason why they do it. It's just in the short term, it supports this share price by creating demand, right? If the company is going and buying the shares, it's bidding the price of the share up.
The influence that the market gonna have
Yes.
prices and the retained earning is negative for one period is nothing, right?
Well, the retained earnings is you can see they're kind of maintaining the balance, right? It's like 5 billion less, but it's mostly unchanged. If they didn't do any stock buybacks, even in this one period, it would go to positive, right? But this is what I'm saying. They're returning most of their profits back to the shareholders in some form, and mostly through stock buyback. Yeah. So yeah, I mean, this again, why the balance sheet is a little misleading, because if you just looked at retained earnings, you would see a negative number and you'd be like, oh, is Apple just never been profitable? That's totally untrue, right? They're extremely profitable, but they just return most of that profit back to their shareholders. Okay, so this is why understanding financial statements and how all this stuff fits together is important because you need to, as an analyst, you need to understand this, right? If you just knew, oh, retained earnings is like the lifetime earnings of the business, and you saw Apple had a negative number, you could come to the wrong conclusion that it's just not a profitable business. But that's not true. Okay. Okay. Another topic that they talk about in the chapter is prior period adjustments. And so if you changed, so this is Tesla. Um, this adjustment that they made, it basically allowed Tesla to pull forward revenue that it was previous. So there's some change in the accounting standard where basically Tesla before in the old standard had recorded cash that it received as unearned revenue as a liability. But the change in this accounting standard is now allowing them to just recognize all the revenue up front. And this is for um, sales with buyback options. Okay, so for whatever reason, the standards for how to account for this changed. And it sounds like it's more aggressive, like to allow a company that is first booking unearned revenue and has to recognize revenue over time to now just let them recognize all of it as revenue up front. We'd have to look into the details. I don't know the details of ASC 606. That's the accounting rule. But for whatever reason, they were allowed to basically pull forward $623 million of profit. Okay. And so that's what this accounting change is doing. Well, actually offset by this. So around $500 million they were able to recognize. Okay. You can still see that Tesla has been in general has had more net losses over time than, um, as you can see, I don't think they pay a dividend or buy back stock. They don't do either one. They just have lost a lot of money historically. Okay. Um, but yeah, the point is that when you have some accounting change that's retroactive, they will just do like a net adjustment. You can see here, this is the net of revenues minus expenses. Okay. They're giving you the change in profit from this change in the accounting rules. Okay. And so this could be, this might be based on estimates. How they got this number, we'd have to dig into more detail. And maybe we wouldn't know enough from just the disclosures. Okay. So you're kind of trusting the accountants and the auditors to make sure that this number is correct. Okay. But in general, these prior period adjustments are just going to be shown on this statement of equity, basically. Okay. Um, so this is again Apple's income statement, um, sales, their expenses. Okay. This is cost of goods sold. This is operating expenses. Okay. So you can see here, this is their revenue. Revenues minus expense. This is their net income. What they're doing here is they're taking this net income and they're dividing by the number of shares outstanding. And they're giving you the share count here. Now, why these two, basic versus diluted? The diluted is assuming all the stock options that exist, all like the share, like there's certain types of transactions where there could be shares that are issued, like a stock option. It's assuming everything gets executed, and this is like the full share count of shares outstanding. Okay. So usually people will use the diluted, okay, to look at earnings per share. So they take this is like the total pizza pie, and they're dividing by this many shares outstanding, 15 billion, and that's giving you the earnings per share. Okay, so if a share of Apple stock is $200, what are you getting for that? You're getting $7.46 of earnings per share. Okay, so this earnings, even revenue per share, this is all useful information because in the end, you as a shareholder care about what you're paying and what you're getting for your one share of stock. Okay, so earnings per share is very useful as an investor. Um, yes, you care about overall how the business is doing, but when you're making an investment decision, you're doing a cost benefit. You know what you have to pay. This is what you're paying, or investing, you can say, investing. And this is what you're getting in the end, $7.46 worth of profit. So in order to do this cost benefit analysis, you need to know what the benefit is. And that's why earnings per share is presented right on the income statement because it's so important. Okay. This $200 per share, that's not on the income statement. Where would you get this price per share? Where is that located? Yeah. Yeah, you'd have to go to Google Finance and look at this value of Apple stock. It's not going to be in the financial statements, right? Because that's a market determined price. Okay. You can think about it like this. The financial statements are always backwards looking. There have to be transactions that happen. Yes, there's estimates that are based on what's going to happen in the future, but really it's like a more backwards looking thing. The stock market is forward looking. It's projecting things into the future. Okay, so they're related because a good way to predict the future is to look at what's happened already. But really, the stock market is a forward-looking thing. Okay, so you can think about it like that. Yeah,
I'm trying to understand, like, if I invest $100, right?
yeah,
$100 per $200,
yeah,
and I will receive $7.46 per year.
yeah. That's the earning. Yeah, so these are yearly numbers.
So it's like a little bit over 3.5% per year.
Yeah,
So that's
it's not. Yeah. I mean, if you do it for other companies like Palantir, it's like so ridiculously low. But what is the hope? They're hoping. Well, you can see it here. You can see that it's growing over time, right? So, I mean, you could think of it as $200 divided by 7.46. This is the number of years it will take for you to earn your money back just to break even. But what people are thinking is that, well, this is not a static number. This is going to grow over time. Now, you can do the math. Now, you have Excel. You can figure out, well, if I grow this at 15% a year, how many years then? It will be obviously less than just dividing 200 by 7.46, but maybe instead of 20 years, it's going to be 16 years, and maybe you're like, that break even time is still too long, right? So yeah, so this is why I think a lot of people who are investing that aren't sophisticated, they don't understand valuation. This is all related to stock valuation. Yeah. Yeah, of course. They can stop their stock buyback program, but they do that because they want, like, this share count you can see is going down, right? Every year, the share count has been declining because they're buying back stock, right? If they stop doing that, then the earnings per share is gonna start declining too, because they're basically reducing the number of slices every year, right?
and that's why the increase in the price per share.
Yeah, I mean, well, yeah, that's part of it. But really what they're trying to do is maintain this number because the $200 is based on this, how the stock is priced will be largely influenced by the earnings per share. Okay, so again, uh, the way that this was calculated, it's 112 billion in total net income was divided by the total number of shares to get this 7.46. Okay. The price to earnings ratio. So this is now, so the price per share was $260. 260 divided by the earnings per share is 34.9. So that's essentially the number of years at current earnings it would take for you to just recoup your money in earnings. Okay. So some might think that that's too high. Some people might be, well, like, if I expect the earnings per share to grow and I'm going to hold it for a long time, and that when after 20 years, it's not like the value of the stock will be zero. I can also sell the shares for more than what I bought it for, right? So this is what stock valuation is all about. You have to use assumptions, use your judgment, use your understanding of Apple's business to project forward. It's not easy. It's a very difficult task to do. Okay. Yeah. Uh, so right now, the price to earnings ratio for Apple, at least at this time, was 35. Palantir in 2026, that same ratio is 200. Okay. So you could think about Palantir if at current earnings, it would take you 200 years to recoup your investment at today's prices. Okay. So, I would not recommend investing in Palantir because there's very few businesses that, first of all, can survive 200 years and maintain their profitability and grow it. Okay. So it's a very risky investment to make. I don't know. the current investors who are buying at those prices, I don't know what they're thinking. I would love to hear their thoughts, but it doesn't usually make sense historically to buy something at such a high valuation. Okay. Um, okay. And then finally, we have return on common equity. Okay. So this is going to look at the balance sheet numbers and figure out how much net income is being returned on actual amount of investment that the shareholders have contributed, right? Because this is going to be based on how much money was actually contributed to the business. Because it could be that a business just sold stock in their IPO one time and never raised any more money. And it's purely financed through borrowing and through retained earnings. Okay. So the balance sheet is only going to have what the business is actually taken from investors. Okay. Through paid in capital, which is here. And in this case, it's an accumulated deficit. But this is what we call the book value. Book value. It's different than the market cap, as we talked about. But the book value, again, is related to how much capital is actually invested from investors. Okay. So it's good to know how much of that, like what is the actual return on that actual investment from investors. So um, again, the value of capital invested is the contributed capital and the retained earnings. Okay. And the return on equity is answering what percent return is the equity capital earning. Okay. Um, so the formula is net income, which is kind of the total pool available minus any amount paid to the preferred shareholders. So that will give you how much the common shareholder is kind of entitled to. And then you divide that by average common shareholder equity, which is the book value of equity. So for Apple, we can see that our average common shareholder equity is basically this amount and this amount, the average, because this is beginning of year, this is end of year. So the average of the year is just this plus this divided by 2. So that's where we got this. The return on equity is equal to the net income, which was 112. That came from the income statement, divided by this, uh, basically this average equity, and it's 171%. So if you could buy Apple stock at its book value, which is 73 billion, then you would be making 171% return every year. So why do you think the business doesn't trade at book value? It trades at, the 73 billion, and I think it's in the trillions is the valuation. It trades at many multiples of book value in the market. It's because the value, the income generated is very high. So the stock price is going to be high. So the book value is not really um, related to the market value. The market value is going to be taking this and being like, well, how much would I pay to earn that much? Right? It's going to be whatever, $1 trillion. If I can earn $100 billion a year, I'm willing to pay maybe 10 times that for the business, which is like a trillion, right? So the book value is not always useful, especially for tech companies that have a very low book value. But like insurance businesses, there are some businesses that trade very close to the book value. The market value and the book value are more aligned. Okay. Yeah. So here, 3.8 trillion divided by 70. So Apple trades for a 51x price to book value. Okay. And in that case, the return on equity is not very meaningful. But like, I just bought some stock today. It's an insurance company. They trade at like 1.2 times price to book. And their return on equity, if you use the book value, is around 20%. So I'm trying to buy this business at near book value. The stock dropped a lot today. Um, their earnings, they showed a loss. And if you guys want to understand more, I can tell you like more details. But the earnings, I read through the earnings. call and I looked at the press release and they were actually good. There was a certain technical reason why they showed a loss, but the stock was down like 8 or 9% today. And I know this stock really well. So I was trying to buy because now instead of like 1.4 times book value, it's trading like 1.2 after today. So I'm like, this is a good deal. I wanted to buy more. Okay, so the reason I'm confident, I'm not scared that it dropped 10% is because I understand the business. I can read its financials, and I'm like very happy that it dropped actually, because the performance of the underlying business was very good. It's just the stock is down for, you know, technical reasons, trading headlines, as they say. Okay, all right, so that's it, I think, for the chapter. It's a pretty challenging chapter. You may have to like just watch some of the practice problem videos to do the homework. I think this chapter is a little harder. Okay.